Welcome to the Hayley Eich podcast. In this episode, I speak to Antonio, who is an investor that was early in Palantir, Tesla, AMD, Spotify, and HIMS. We speak about his 5-stock portfolio, why he thinks Palantir could be bigger than Tesla in the future, why he's in AMD and not NVIDIA, and so much more. So without further ado, I hope you enjoy. Welcome, Antonio, to the podcast. Thank you very much for joining me today.
Thank you so much for having me on. Very excited.
Of course. I've actually been quite excited to speak to you, and I've been following you on your X account for a while, and I wanted to reach out to see if you'd come on today, because one thing that I really appreciate about what you're doing is that you strike me as someone who isn't really afraid to go against what everyone else is doing. You're not afraid to share your own opinions on your stocks and stand by them. And I like that, because I think a lot of people in this sort of niche get quite tied up with what everyone else is doing in their portfolio. So I appreciate that about you, and I enjoy your analysis of your stocks, and I think, you know, my audience will enjoy learning more what you have to say today. So it should be a good one. But
yeah, well, thank you. I'm a big fan of your content too, so I'm excited for this.
Cool. Thank you. So let's start with your portfolio. Let's start there, and then we'll sort of unpick it and work through what you have, why you have it, some thoughts on different investments, and we'll just see where the conversation takes us. But for people watching this right now, I'm going to put on the screen Antonio's portfolio, so you'll be able to see it. But for the audio listeners, I'm just going to quickly read what his portfolio looks like. So you've got 5 stocks in your portfolio. You've got Tesla, AMD, Palantir, Spotify, and HIMS and Hers Health. So there's a lot I want to ask you about this portfolio. I think it's a super interesting portfolio. Now, firstly, there's no indication that I can find on your X account as to the allocation of these 5 companies in your portfolio. Are you happy to share that information? Or if you're not happy to share allocation, perhaps you could just tell us the largest position maybe?
I'm actually thinking about it lately because, you know, when you start out with this internet thing, you don't want to share too much. And then you get comfortable sharing more. And of course, I've ended up sharing more than I ever thought I was going to share. And I'm thinking about disclosing the percentages. But what I can say for now is that in terms of allocation, it's sort of fairly evenly distributed. And of my latest picks, so I've been an AMD and Tesla shareholder for almost 10 years now.
That's
and
amazing.
My latest picks are, thanks. My latest picks are Palantir, Spotify, and HIMS. And so the biggest one of these 3 by a relatively large margin is Spotify.
Okay.
And especially after I doubled down at $97.
Okay.
Because I try to allocate in terms, generally what I try to do with my portfolio is look for companies that have a sort of remarkable asymmetric potential, in that there's a potential large upside and then the downside is relatively capped. And so actually one of the metrics that I use to discern whether I should allocate more or less in a company is the balance sheet strength. And so Spotify and Palantir both have an amazing balance sheet, but of course I have a better read on Spotify as a business because it's a consumer-facing business. And so I see people using the app. I'm a user myself. And so I understand that business better than I could possibly ever understand Palantir, because it's a business-to-business business. And it's sort of harder to get a read on. And actually, the way I got a read on Palantir is by reverse engineering market signals. So the uncertainty was higher. But of course, I only have 5 stocks. And so each of these positions are actually quite meaningful to me now. I actually made some mistakes in the past few years, which I liquidated, and I wrote about them and stuff. And I lost some money there. And what I did was concentrate that money into HIMS. So HIMS is now therefore a sizable position too. And I would say at this stage, each of these 5 picks are quite strong convictions.
Okay, no, that makes complete sense. I think, you're spot on there. How much do you share online? Because the more you share, naturally, the more the opinions come. You know, why have you got this over this? Why have you got this much in this compared to this? And it does open you up to a whole can of worms. But it's exciting to hear that you've been a Tesla investor specifically, because that's one of my largest holdings, for for a long time. So I'll definitely pick your brain a little bit about that. But I'm assuming here, maybe I'm wrong, that your portfolio hasn't always looked like this. Maybe you haven't always had these 5 stocks. Maybe you haven't always had only 5 stocks. Can you talk a little bit about maybe what your portfolio looked like when you started and like the main shifts that it's taken and why it's ended here with just 5 and these 5? Big question.
Yeah, sure. Definitely, yeah. So I started in 2014 and I bought AMD and I bought Solar City, which is a company that was specialized in solar panels at that point in time. And then Tesla came and acquired this company at a 50% discount in 2016. So then I evaluated Tesla and I said, I'm going long this company. And so I didn't sell the Tesla shares that I got from the transaction. And that remained like so largely until 2020 when I got into investing full time. So before I got into investing full time, I was an entrepreneur. I got very deep into studying neural networks. I did many different things, but mostly I was an entrepreneur. And I was a student of things. One of my passions is just studying random things. So I took a lot of time to do that. Yeah, it's a lot of fun. It's cool to know that you like it too. And so after I got into this full time in 2020, I made these new investments, which include Palantir and Spotify. I didn't necessarily get into them in 2020. I actually can't remember the exact dates now, but I definitely I started making 2 investments back then, which were GoPro and BlackBerry. Because GoPro, after burning everyone in the stock market, I figured that the company was going to turn around. And then BlackBerry, I liked the technology. I thought it was a very undervalued technology platform, and I still think it is. But in my thinking, there were 2 flaws mainly, which is one, GoPro could turn around, and in fact, I think they are going to turn around, but it's a company that doesn't have exponential growth potential as perhaps Palantir, Tesla, HIMS, things like that. So I eventually liquidated it because I figured it was a waste of time. And then with BlackBerry, what they didn't have was the organizational properties in order to extract value from that technological platform, which if you look at a company like Palantir, Spotify, any of these companies that I own, fundamentally what they are is excellent organizations. BlackBerry was a mediocre one filled with politics. And so I liquidated these 2. And so those 2 exited my portfolio. And when they did, I put that money into HIMS, as I was saying. And so over the past 3 to 4 years now, I've been building a conviction in Palantir, Spotify, and HIMS, and I've kept my AMD and Tesla shares. And I actually bought some more AMD in 2021. I think it was at around $75. I made quite a big purchase. So it's been a function of not just picking 5 out of the blue, but owning Tesla and AMD for the past decade. Adding some more to AMD along the way, and then looking for excellent companies with high, remarkable asymmetric potential, which I believe at this point are possibly one of the best companies you can own, in my view, is Spotify, and so is Palantir and HIMS. So that's how the portfolio came about.
So would it be fair to say that you've never really gone on board with the whole diversification argument? Because it sounds like you've never just put your money into an ETF and called it a day. It sounds like you've never had a 30 stock portfolio.
Well, of course, I have plenty of survivorship. I think it's called survivor bias inside me, or survivorship bias, in that I've done very well over the past decade. And of course, I'm convinced I can do that again. And so it's possibly due to a psychological flaw, right? But then at the same time, I figure that if you spend time learning about the world and then identifying companies that match with your view of where the world is headed and not where you actually want it to head, I think that it's possible to obtain great returns. Because at the end of the day, if you index your money, which is a great strategy, and probably it's the best for, statistically speaking, you are going to obtain returns as far as the economy grows. So if you're indexed in the S&P 500, you're going to grow with the American economy, which is a great deal. But if you find a great business, you're going to grow with that business too. And so, if you spend a lot of time looking at different businesses, I think you end up building a kind of neural network that tells you when something is likely to not be a great business, when something is a great business, and then when something is truly exceptional. And so I found that betting in truly exceptional companies really pays off. If you look at Spotify, the stock did very badly from 2021 so pretty much last year, and the stock got decimated, right? And I had such a fundamental understanding of the company, and I was so convinced of the value that it adds to customers and of the way, the management team orchestrates the company and stuff, that I was very happy to put a lot of money in at $97, and that's worked out very well. Ultimately, because it's just tracking the increased free cash flow per share levels. And when you find a company that can do that, which is increase free cash flow per share over the long term, I think that it's worthwhile pursuing, especially if you're young. I don't have a family to feed or anything, so I'm willing to play ball for now.
Yeah, I love that. I love the way that you describe that, because for me, it happened a little bit differently, right? Because I started not really having done much research. I started in a very typical way, whereby I came across this idea of investing, then came the index funds, diversification is a must, all of this stuff. And that's the path I followed until then I started getting obsessed and started researching everything that I could to do with investing. And there were some companies that just took my interest, and I started researching them, Tesla being one of them, later down the line, Palantir. And then it kind of came to the point where I became so convicted in these particular companies that it sort of felt more risky to just put my money into something that's tracking the index, that's tracking the market, rather than actually doubling down on a few different positions that I follow and I understand way better than maybe the average. I'm not saying I understand Tesla more than anyone on this in this world, but compared to maybe someone that isn't going to be more concentrated, I could afford to take that risk because I'd done the research. I think that's kind of how I view it. And I think it's this wealth generation versus wealth preservation view. Like you said, it depends where you are in your life. You can afford or you can't afford to take more risk on. And I'm in agreement with that.
I totally agree with that. I always tell my students that I don't think anyone can really predict the future. But what we can do is buy vehicles that are likely to successfully encounter and defeat problems as they go along, right? So ultimately what a company does is solve problems for customers. And so if you find a company that's organizationally excellent in that, and usually it can be seen in this sort of properties, like, is it flat hierarchically speaking? Is it filled with politics, or is it filled with meritocracy? Does this company innovate really fast? Are they happy to cannibalize their business when they have to? Do they repeatedly defeat much larger competitors when the odds of them doing so are low, and stuff like that? When you see a company that is truly a statistical anomaly in the way they've executed, and it looks different, it feels different to you, then sometimes you can get comfortable betting that this company will continue solving problems going forward, will be thus hard to disrupt, will be able to tap into new markets, and ultimately will be able to increase free cash flow per share. So that's just to sort of get a bit more technical in how I think I find these companies and how I think you do it too. That's the feeling we have with these companies, just comes down to that.
Yeah, that was sort of going to be my next question. You've hinted at it, but we'll just talk about this because I think this will help a lot of people. So looking at your portfolio, there's quite a lot of similarities, and you've already sort of spoken about many of these between these positions, right? These are all companies innovating. These are all companies that are seeing bigger growth than maybe the average market. These are companies that have, in my opinion, and probably your opinion, excellent leadership. These are companies that are going against the grain. These are companies that are hitting a lot of different metrics that myself and yourself are looking for. But just maybe, if you can you summarize a few different things that you absolutely have to see in a company for it to even enter your portfolio? Like, what are the links between these companies that have made them take place in your portfolio?
So I would say, firstly, asymmetry, in that I see a very big upside and therefore makes the investment opportunity worth pursuing, together with a relatively capped downside. So for instance, let's take Palantir. I believe that the commercial business has great upside, and the government business presents the relatively limited downside, in that it's a software that's very hard to substitute for the governments, for the military, and so forth. And then, of course, the US commercial thing, or the commercial thing broadly, may or may not take off exponentially, but it does. That's how you get the big upside. So one, asymmetry. Two, a philosophy of management, which Nick Sleep termed as economies of scale shared, which is basically when a company focuses on continuously giving customers better and better deals so that ultimately they achieve economies of scale, and then they share that back to customers in the form of lower prices. So the quintessential example of that are Walmart and Costco. Every time they do more business, then they then reinvest that capital in order to be able to decrease prices for customers and then continue gaining market share. Because ultimately what happens in the market, in capitalism broadly, is that every additional dollar you make is an added incentive for disruption for the market to come in and take that dollar from you. So therefore, in order for free cash flow per share to increase over the long term, every time you think about making a dollar, you have to do it in a way that's defensible. And so economies of scale shared for me is the best way to do that. And if you look at a company like Tesla, there's actually some very cool graphs which I could pull out. But if you look at their metrics, which I hope I get this one right because it's off the top of my head, I believe it is free cash flow. Yeah, it's free cash flow divided by operating margin. You will see that it trends up, and then usually when it gets to a certain level, then it just plummets down. And why is that? Because as that metric goes up, it means that Tesla is producing more free cash flow per unit of operating margin. It means that the company gets better at producing more cash per unit of operating efficiency. And when it plummets, it's because they achieved a new level of efficiency, and then they proceed to decrease prices. And then it trends back up again and then down again. And so that's what has made Tesla a free cash flow machine, in that no one in the market, at least in the West, produces electric cars with the vertically integrated software stack as they do at the price they do. And there's no one that comes even close. And they create that barrier of entry, one, by the difficulty of the task that they face every day, but then by making it increasingly difficult for competitors to come in and do this in a way that makes economic sense. So asymmetry, economies of scale shared.
Yeah, I love what you said about Tesla there. Let's just stay on Tesla for a minute, because that's Tesla and Palantir are how our portfolios cross over. That's the common thread between our portfolios. Have you happened to have time to read the ARK Invest model that came out with the new price targets? It came out yesterday. Don't know if you've had time yet.
I haven't.
You haven't?
I actually don't. I don't do models. But
no, that's okay. I was just going to say, in their models, they have price targets for 2029, but they are not really including Optimus as something that really impacts Tesla in the next 5 years. How are you looking at Tesla in the next 5 to 10 years? Are you thinking robo-taxi is going to be the biggest thing for them? Are you thinking Optimus? Are you thinking it's going to be EVs, energy? Like, how are you seeing their business transform? Because right now, in my opinion, they are at the start of a big transformation.
Yeah, so how I see this is from I do actually do models, but I do them in a much looser way. I'll explain. I frame that investment in a probabilistic manner, which is I see them compounding 3 curves at the same time, which is manufacturing, energy, and then AI, with the whole vertical integration, so the hardware and the software and everything. And so I don't see any other company in the West, and companies in China, you can't really tell when they're being truthful or not, which is the reason for which I don't invest there. I'm not seeing any other company compound those 3 curves simultaneously or individually as fast and as reliably as Tesla. And so what I think is going to happen is that these 3 curves are going to come together, but for the investment to do very well, they don't all 3 have to come together. So it could just be a combination of manufacturing and AI, or manufacturing and energy. Say AI is a fad and then it doesn't pick up. The investment per se doesn't fully depend on AI. I think that if they continue to get very good at manufacturing and then continue to get very good at energy, I think that the returns can be amazing. And so along the way, how these 3 curves combine, or to what degree they do, can materialize into a spectrum of platforms. So Optimus, I think, is the ultimate expression of getting automation and energy and manufacturing right, in that you can just put out into the economy robots that do things for humans. In my view, when I said in Twitter, on X now I should say, that this company can go to $10,000 per share, I really mean it. Of course, it's not in a 2 to 5 year time horizon. I'm always thinking 10 to 15, 20 years out. But if you think about it, the economy is just people processing information to figure out what to go and do next and then do it. And so a lot of that information processing happens at a relatively replicable level. So think about people doing more manual jobs, drivers, people driving around, people picking things up, people pushing buttons, stuff like that. That can all be replaced with this technological platform. And so I think that Tesla has very high odds of creating something that resembles the internet in terms of its impact. All the internet really does is just make it faster and cheaper for us to send information packages around. And Tesla's doing that, but for the physical world, which is, hey, instead of you getting up in the mornings and going and move things around, you can just push a button, or don't even have to do that and have a robot do that for you. So I think that's going to very likely play out to different degrees.
Yeah, I think it's interesting because Elon has obviously put out a few different predictions as to how many bots will be per person eventually. I think his latest one is between 2 and 10 bots per person, which I mean, who knows if that's possible? Like it can absolutely be possible. It blows my mind to think about what shift we're going to see happen in society. Like it's going to, if it all plays out as what Elon's thinking, it's going to look very, very different. And then obviously comes in the argument of, okay, well, is that going to mean people are going to lose jobs, or is that going to mean more jobs are created and people panicking about this, that, and the other? But let's just, so you made a little remark there about something you put on X. I'm just going to read out your tweet because people might not know. So you said, if Tesla nails robo-taxis, it's heading to $10,000 per share. You got a lot of impressions on that. And I can imagine, I haven't read the comments on it. I can imagine some people were very in agreement with you. And I can imagine some people were thinking and saying, not a chance. But you haven't given a timeline there for a start. So that's important because, this could be 20 years out. And also, do you want to talk us through what you're seeing for the robotaxi, how you're seeing it contribute to this sort of, to this level, really? And by the way, I'm in agreement with you. I think robotaxi has, if Tesla does nail it, as you say, I think it's going to be very big. And I think it's really going to add a lot of value to Tesla. But I'd like to hear it from you, what you're seeing there.
Yeah, sure. So look, I think that the market largely has a tendency to look at these companies as discrete things in time, as in, if this quarter doesn't go well, this is a bad company. If it goes really well, this is a good company, right? And so when I said that about robotaxis, for robotaxis to happen at scale, you already have these three curves that I was talking about to a point of maturity, whereby if you continue to compound on them for maybe, who knows, 2 to 5 to 10 years, it's eventually going to go way beyond just robotaxis, and it's going to evolve into automation at a marginal cost, both in terms of the production of getting the machines out there, both in terms of the intelligence compounding over time, getting more and more intelligent, doing things of more value for less money over time, and in terms of powering them. And so that is a way of expressing, which I think was quite effective in terms of getting the message out there, of how actually these three curves are not yet visibly intermingling, but they will do. And if you look at the graphs from the last quarter, you will see how both FSD and the energy storage business are growing exponentially. And actually, people forget about this, but in 2020, Tesla went up towards the end of 2021 tenfold. And the reason that happened is that they went through production hell, as Elon Musk termed it, in order to bring the Model 3 to life. Because bringing the Model 3 to life required a quantum leap in manufacturing. So that curve, the manufacturing curve, did show up there. And since, we've been trading kind of flattish, right? And so what I'm seeing now is that just as they compounded manufacturing to create the free cash flow machine that the market then proceeded to love in 2021, they're doing the same with energy and AI right now. And that's going to take a couple of years to rear its head. I think it's firstly going to do it in the form of robo-taxis. And then I think it's gonna continue to platformize, so to speak, into higher levels of relevance for the broader economy.
Yeah, I see that happening as well. And I think it's going to be a very interesting journey to track. And I like what you said there about, it depends if you're looking at this short term or long term. If you're looking at Tesla being a short term hold for you, very volatile position, you can't really guarantee these massive returns. But long term, if everything works out what we're thinking, it could be a very, very good position. So I don't want to spend too long on Tesla because you've got other interesting companies that I'm eager to learn about. Talk to me about HIMS and Her Health. Now, I'm not going to claim to know much about this company at all. I know the very basics that I need to know, sort of what they do and why they may be good in the future. But what are you seeing there?
So essentially, the US healthcare industry is an inflationary hamster wheel. I'm, of course, not saying that practitioners don't care about patients. That's not the case. But it's a system that has a remarkable inflationary tendency. And so every year prices go up because the market is a monopsony in that there is only one actual customer in the space, which is the insurance companies. And in terms of the economy at large, they behave as just one single driver of demand. Because what happens is that the practitioners want to make more money naturally. And so they have the incentives to raise prices a little bit every year, because then they know that these price increases get absorbed by the insurance companies. And so this had a great, this actually had a sense after World War II, because this enabled people, a lot of people, to access healthcare that previously weren't. So the system is not malign for itself, but today it's malfunctioning because that inflationary hamster wheel has gotten to the point where the amount of money that people have to pay out of pocket on top of their insurance fees makes a lot of the healthcare system largely prohibitive in terms of the price. It makes it inaccessible. And so the entire industry is heading that way. Any single attempt in the past few decades that I've studied of trying to reverse that inflationary tendency has failed. So if you want to make money, if you want to sustainably participate in the US healthcare industry, you need to engage in this inflationary hamster wheel. In fact, in 2018, Jeff Bezos, Jamie Dimon, and Warren Buffett came together to try and fix this issue. So 3 of the brightest minds on the planet. And soon after, they gave up because it was incredibly complex. The sole problem that they were after is reversing that inflationary tendency. And they couldn't really figure out how to do it. The partnership dissolved. I'm not even sure if they formalized it legally, but they came together and they couldn't do it. And along comes HIMS, which is operating outside of the traditional insurance system, and it's producing positive cash from operations, and it's growing exponentially, and it's finding continuously new verticals to tap into and essentially give their customers slash patients a solution for cheaper in a way that's more convenient and in a way that provides better outcomes. And by the way, as they do that, they are having to assemble pieces of the business which on its own, not considering the difficulty of tapping into this market sustainably while doing so outside of the traditional inflationary hamster wheel, would be impossible to do, right? So these guys are competing with CVS, with other companies, other giants of the sort, and the iOS app ranks among these companies. And this company was just created 7 years ago. The iOS app was created 2 years ago. The vertically integrated pharmacy infrastructure, which they need to automatically send medicines out to their patients after connecting them online with practitioners, was only created a few years ago. So all of these things have been created on the fly, and they've essentially created a vertically integrated pharmacy infrastructure, which connects patients with physicians in a way that no one else can match in terms of price, convenience, and breadth of selection. And they continue to execute in this way, which makes me think that this is a management team that I can bet on. I think that this is an excellent company, organizationally speaking, with the appropriate DNA to continue compounding their way through this system, acting as a deflationary force, and of course, compounding a great deal of goodwill with patients in the US healthcare industry, because patients are tired of the opposite. Patients are tired of the inflationary tendency. They want something that is up to date in terms of their expectations in other sectors in the 21st century. So nowadays, we're used to pressing a button with Uber and having a car come to us in a way that's cheap, convenient, and fast, right? And so people want that with healthcare now. And to me, HIMS is unrivaled in that sense. Additionally, when I bought HIMS, my impression was that the company was very undervalued on its own because it was trading at a very low price to sales ratio, which is the metric that I use to assess enthusiasm, right? And so what we've seen now is basically a multiple expansion. And so 2 factors, which is 1, the business continuing to be fundamentally excellent and grow, and 2, the multiple expansion. I think the combination of these 2 factors can make for a wonderful investment. And I got into this company at $15 per share. So at the moment, I think it's up something like, I think it's up 60% or 55 or 50, something like that.
Yeah, it's a really, really interesting business model, actually. I got a few questions here. So firstly, you've mentioned there about the US market. I don't know if they operate outside of the US market, but if they don't, do you see them being able to? Second question is, what are you thinking competition wise? Because it's obviously early days in this industry. Do you think that, potentially there could be quite a lot of competition, maybe from a bigger player that's already existing, but not in that area? And three, I'm just going to have a look at this in case I'm really wrong. No, okay. So yeah, so the stock has gone up by quite a lot in a very short time period. So 6 months up by 174% or whatever it is. What are the main drivers causing that? So those are my three questions about this stock.
Got it. So about the international expansion, I think that the US market is particularly ripe for a disruption of this sort, just because it's particularly dysfunctional. So a market like the Spanish healthcare market, I don't think it's as dysfunctional. Having said that, that just means that the barrier of efficiency for them to come in and disrupt is higher. But I think if they continue to compound their infrastructure, they can. I mean, Amazon got started out with books, and 20 years after, I think they're only now moving into Portugal, and they have an infrastructure that's radically superior to any commerce in Portugal, right? So I think that over the decades, they can continue to compound their efficiency and then get into markets which are not as dysfunctional. But for now, they have a long runway ahead in the US, where I think that the market actually needs a disruption, as in patients badly want it. And therefore, HIMS is actually solving an acute customer pain, which perhaps in other countries isn't as acute at the moment.
Yeah, that's what I was thinking about the UK market as well. I think they'd have a place in the UK market, and I think they'll do well. But like you said, I think the pain point right now is in the US. But I like what you're thinking there about how you just applied that to Amazon and how Amazon started, and then they've built their infrastructure, and then they were able to enter a market in a much stronger position.
How do you see the pain points in the UK? I'm interested to hear that.
I just think we're moving towards a world of convenience. I think everyone is everywhere. And I think any company that is going to push convenience and cut any sort of barriers for anyone is going to do well, as long as there's a pain point. I don't think the pain point here is anywhere near as big as it is in the US. I don't know about the Spanish healthcare industry. I don't really know what that's like, but I think the UK and it's free.
I mean, it's not free because the government takes everything from you, right? When you make money, they take all your money. No, I'm kidding, but they take a large chunk. But it works relatively well. And actually, the practitioners make little to no money.
Okay. I think it's more. Do you see a world in which HIMS and Hers Health does well in Spain?
Well, I see a future in which they could definitely tap into the pharmacy market. And they could actually very much tap in via the stigmatized conditions, which is what they specialize in now. Because even if healthcare is very accessible and it's very fairly priced, I'd say ridiculously priced in Spain, for stigmatized conditions, I think people don't really want to go out to the doctor. And so that's an interesting avenue for sure. But it's a heavily, heavily regulated market. So within Europe, which is a regulation machine, I think we are one of the well, the UK left the Europe, which I think is interesting. But Spain is very, very heavily regulated. So we'll see. But and then moving on to the competition, I do expect a head-to-head battle with Amazon in the coming years. But it was interesting to see, I think it was in Q4 2023, that Andy Jassy was asked about the pharmacy business by an analyst. And he said, look, we're looking into this. Our customers have asked us for this. And he said, I quote, I paraphrase this. He said, this business has more complexity than the rest of our e-commerce operation together, combined.
Wow.
And so it's a very, very, very complex thing to get running, which is why when people say that HIMS has no moat, I disagree, because I think that they undervalue the difficulty of getting the operation running in the way they have. But I've seen a number of times in which a company has an incredible focus on a particular end customer, such as HIMS does, and Amazon comes along with much more resources and much more muscle, and then they end up giving up. And examples of this are Square, which is now called Block, Spotify, which I'm a big investor in, as you know, And I think that HIMS is going to do well against them because they have a level of focus that Amazon is not going to be able to match. And then about the stock price, it's definitely, the stock is very, very hot right now. I don't like buying into something when it's hot. I like buying into something when it's when everyone hates it, which is sort of what I did with HIMS, perhaps not as much as with Palantir, Spotify, AMD, and Tesla back in the day, because $15, I think $15 was under a price to sales ratio of 4, which is still quite pessimistic. But it's getting hot now, and I don't like to chase stocks. So I obviously recommend everyone to do their own research, of course, but and to ideally buy something when no one wants it. But I think it actually has a very long runway ahead over the long term.
Yeah, cool. So moving gears again, let's do Spotify. Again, not a position I have. Obviously, as with most people, I'm a user of Spotify, and I know it from that angle. In terms of an investment, though, you're obviously seeing this as having a moat. You're seeing this as having a big growth trajectory ahead. Why is that? Why are you seeing Spotify as deserving of a place in your 5-company portfolio?
So it's a number of factors, but one, the more macro factor is that the internet has forgotten about audio and is actually still widely recognized as an illegitimate form of media on the internet.
Okay.
As in, the primary forms of media are video, images, and text. And we've basically left audio behind, when audio is the essence of spoken language. That's how humanity has been communicating forever. And I believe that it's actually catching up now with podcasts and stuff and audiobooks. And I believe it's going to be just as big as video or text or image or even bigger. And so that's arbitrage number one. Arbitrage number two is the fact that Spotify has no real competition, because although there's plenty of people using Apple and Amazon Music, Spotify has a level of focus on audio, previously on music and now on audio, which is unmatched. And so that translates into a marginally better user experience, which in the digital space translates into an exponential advantage in distribution. So if you think about the Google versus Yahoo example, Google at the beginning was marginally better than Yahoo, and the vast majority of the traffic went to Google, which then enabled it to compound its UX by redeploying capital over time and stuff. So marginal differences in user satisfaction in the virtual economy lead to exponential differences in adoption. And so that's actually what's happening with Spotify. If you look at the growth of their mouse and you compare it to Apple and Amazon and so forth, it's just exponentially faster. And so what's happening is that as Spotify deploys more verticals, these verticals have radically better unit economics than music does. Because in the case of music, labels keep 75% of the money that Spotify makes. And that's why traditionally its gross margin was low. And it's one of the reasons why, despite the breakneck pace of MAU growth, monthly active users, the market was not assigning a generous multiple to this company. And so when Spotify got into podcasts, soon after it was number one. I believe it's going to happen again with audiobooks. I believe it's going to continue to happen with subsequent audio verticals, because fundamentally, this is an excellent organization. It works in a way that I think it reminds me of Amazon in the early days. I've studied Amazon very much in depth, and the way the management team thinks, the way they continue to do things like defeat larger customers when no one gives a dime about them, the way they continue to satisfy customers and pass economies of scale back. So I like to say that this is kind of like, if you've ever looked up at the sky into space and you see things moving around, you can often devise the difference between a meteor and a comet, just because the comet leaves a trail because it has water. And so when you look at these companies, they just leave a trail of excellence, right? And so as these verticals come online, the unit economics are going to be better. And so what we're going to see is a transformation of the margin profile and thus of the income statement. And ultimately, that's going to increase free cash flow per share levels over the long term. And actually, if you look at the past 2 to 3 quarters, this is already happening. Because what they've done is, for the past 10 years or so, they've been focused on growing at all costs, right, with the zero interest rate phenomenon and so forth. And then as rates started trending up, Hayley Eich, the CEO, instilled a new focus on the company, which is on producing an excellent business. And so that has been incorporated into the DNA. And so what they're doing is now continuously looking to find ways to leverage the business in a way that ultimately more money accrues to the bottom line and they make more money at the top line. And so this is already starting to bear fruits in the past few quarters. And obviously the market has rewarded the stock. Ever since I doubled down at $97, this is up something like threefold or so forth. And I believe that actually has a long runway, because Spotify is now on its way to 1 billion MAUs, but monthly active users. I don't want to use that term too loosely because some people don't get it. Obviously, it's jargon, right? And so once they get to 1 billion monthly active users, the distance they have from 1 to 3 is shorter than the one they have from 500 million to 1 billion, which is the path we're currently on. And so beyond the transformation of the income statement, what I see this platform as is basically an audio search engine, something like Google, but for audio, that people broadly use to share and consume information in the future. And actually, you see people doing this with YouTube and Spotify now. They go on these platforms to learn, and they simply listen to a podcast like they may do now. And what's interesting about podcasts is that they are very monetizable pieces of inventory, in that you can like a song of Drake or one of these pop artists today, and that's monetizable on its own. But if you're listening to a podcast about investments, or maybe real estate or something like that, the ARPU, the average revenue per user, is bound to be higher, just because the value of the information is so much higher. And so I think that I think the market is going to assign more generous multiples to Spotify over the coming quarters, over the coming years too, and the business is going to continue to produce more free cash flow per share.
That was super interesting, because I've not done that much research into Spotify myself. I know as a user, it's the number one place that I go to for my music, but also, like you said, my podcasts. Occasionally I'll watch podcasts on YouTube as well if I want that visual element to it, and I've just got YouTube up. But yeah, primarily I'm a Spotify user, and I wouldn't really think about going elsewhere. But can you maybe just, for people that are really like new to Spotify, can you just explain the ways in which they currently make money and how you see those areas growing in the future?
Sure. So every time you stream a song, if you are on the free version, ultimately they make money via publicity that you consume, and then they share that with the artists and with the labels. So that's why the gross margins on the music side have been low. Spotify on the music side only keeps around 25% of the money they make. And if you happen to pay a subscription, they share the money equally, but the money doesn't actually come from the publicity, from the ads. It comes from the subscriptions that you pay. So that's the essential flow of the business on the music side. And with the podcasts and the audiobooks, it's the same, except that now they are basically deploying more ads and deploying new subscription formats. So if you are a premium subscriber on Spotify, you may listen to a bunch of ads when you listen to a podcast. And what they're doing with that is paving the way to basically monetize your hours that you spend listening to a podcast, be it via publicity or by getting you to be tired of the ads and eventually have you opt in into another subscription. And so that's how they make money.
And do you see those changing as time goes on, growing, or maybe new revenue streams coming in?
So they have a machine which they call the Spotify machine, which is focused on simply enhancing user lifetime value. And the reason that their UX, their user experience, is better than that of competitors is that they are constantly tweaking the interface and experimenting, and only the modifications that truly increase lifetime value stick. And so I actually don't know how they're going to be monetizing exactly their additional verticals over time. But what I do know is that this machine is going to continue to get better, and they will take whatever decisions they have to monetize. So perhaps with audiobooks, it's better to go via publicity. Perhaps it's better to go via subscription. It will depend on the countries. It will depend on the seasons on which someone signs up for the platform. A customer that signs up during Christmas is perhaps not the same as someone who signs up during the summer, stuff like that. So it's all data science, but they have the machine to sort of abstract that away and take the decisions that they have to. But in essence, they just have to get people to spend more time on the platform, and then get better at monetizing the time that people spend on the platform.
Yeah, I think I saw as well that in the UK they were trialing a courses feature. I think, if I'm right, my memory serves me right there. So that could be maybe another avenue in the future. for further
Totally.
growth,
So yeah,
perhaps. Yeah.
yeah, absolutely.
Mm.
So the other avenue that they have beyond this, which I'm a big fan of, but it's very abstract, is the idea of connecting consumers and fans in a more intense way over time. So think
Okay.
about it this way: if you're a fan of the All In Pod, they can sell you
Mhm.
courses, they can sell you events, they can sell you special communities that you take that you go and be a part of, stuff like that. So because creators always want to make more money, and
Mhm.
consumers always want to get closer to the creator, or at least a part of them, a percentage of them. And so
Mhm.
there's a lot that they can do to connect both parties and effectively solve problems for them. And as the volume of problems that they solve for these two counterparties grows, then the monetization is likely to trend up too. And that is just how Amazon has done it. Sorry, Amazon over the past few decades has basically just solved more and more problems for shoppers, for merchants, and for developers via AWS. And they're constantly looking for ways to do that, again, in a way that's increasingly hard to imitate at scale profitably. And sharing economies of scale is a part of that. Because if you want to go and replicate something like Spotify has, well, you have to share economies of scale to the same extent that they do. And that's very, very hard now. And even more so with higher rates, which I don't actually bet on rates, right? But the point is that replicating those infrastructures that consistently think every day about how to give more value to customers for less is very hard. And so
Mhm.
the optionality is infinite once they have that mindset among the population.
Mhm. So do you see Spotify competing more so as time goes on with the likes of YouTube?
Yeah, yeah, definitely.
Mm.
I think that we are in an economy in which we have increasing winner takes all scenarios. But I think that in
Mhm.
many cases we have a bunch of platforms that compete for the number one position and they can coexist. But
Yeah.
it's strange because if you look at YouTube, the use case is marginally different. You almost use it at a different time of the day. I personally
Mm.
use YouTube just before going to bed. I like to watch podcasts
Okay.
and I actually
Interesting.
learn. It's very weird, but I like to learn about things just as I'm falling asleep. And then I'll use
Well,
Spotify during the
it helps
day.
you learn it.
Yeah, I often have dreams about it and everything, so but it makes me fall asleep too. Yeah, but it's kind of like they have different use cases and people use them at different times of the day. But I think they will compete,
Mhm.
increasingly so over time. But so long as the organizational properties of Spotify remain and ideally continue to get better, I think that the competition will be successful.
Hmm. Maybe I should do some more research into Spotify. So I want to read out a a post that you put on X
Hmm.
because I think this is really interesting. So I think this was last night, actually. It was a very recent one that you put, and you put the 5 hardest companies to disrupt on earth are the following: Amazon, Costco, Google, Apple, and Tesla. I absolutely couldn't agree more with those that you've put there. But my question is this: why are some of these not in your portfolio? Like, what's stopping you from adding Amazon if you think it's such a difficult company to disrupt? Is it because you think that there's more growth in other companies, or is it because there's a particular risk factor that you're seeing with maybe a Google and an Amazon?
No, it's because I like to invest in younger companies that I
Okay.
think are going to be among the more undisruptible companies in 10,
Mhm.
15, 20 years time. I actually do study these companies that I mentioned. And in
Mhm.
fact, when Amazon dropped during a few years ago, at the same time at which Meta dropped, or soon
Yes.
after, or whatever, I wrote a deep dive about this. I actually advised my some family members to buy a lot of it, and it's been very,
Mhm.
very successful. But they are older, and they have a different view of reality, right? And so it was
Mhm.
ideal for them. But for me, I think Palantir and Spotify and stuff like that is a better pick because I see a better upside and I see very good odds of these companies evolving into very, very undisruptible platforms. They already are actually, in my view,
Mhm.
but I think they will get much better over time. And it's just the upside is much bigger, and I
Yeah.
have to make more money, right? I'm still relatively young, and there's lots of things to pay for.
Yeah. I thought that would be your answer. So you've also said, and I need to pick into your brains a little bit about this post on X. So Palantir is going to be bigger than Tesla. Talk to me about that because again, I imagine a lot of people disagreed with you on this, and I imagine a lot of people also agreed with you. It's quite a statement. And I can kind of see where you're coming from. I have both in my portfolio, as do you. So obviously we're bullish on both. But what did you find out that made you post that?
So my view is that on the next decade, we are on an accelerated path to commoditize a lot of things. And so the last thing that's going to be commoditized, in my view, is data custody. And so you can understand data custody. There's a spectrum to which you can understand that statement. But let me explain what I mean exactly. If you think about what a company is, it's basically an optimization function. So it's basically about minimizing inputs and maximizing outputs over time. So in a way that's defensible and so forth. So that ultimately free cash flow per share goes up and shareholders make money. That's a way of defining a company. And so the way we've been doing that up to now is by subjectively picking up data, have people study MBAs and things like that, and then have them pick up data, subjectively process it and take decisions. But that means that a lot of that data just basically either doesn't get captured or it gets forgotten. So we've been running that optimization function with a pencil and a piece of paper, roughly, ever since capitalism got started. And now what we have is infrastructure that allows us to digitize the operations and effectively create digital twins of these companies. And so the most important asset of companies now, and this is going to be even more so over the coming few decades, is their digital twin, their data. And so we're going to see things get commoditized in the operation of the company until eventually, in my view, we're going to be left with a digital twin and then people sitting around the twin taking decisions. That's what I think it's going to evolve into, especially as we consider how Tesla is building this platform that could automate a lot of the manual work, moving things around, producing things, stuff like that. I'm not saying that every single human job is going to get displaced. I think that humans are going to go and do stuff that the machines can't do. But I think that the most important thing that a company will own is the data and the infrastructure that enables the custody of the data, the actualization of the data, so the constant generation, curation, and so forth of new data, so that data doesn't get siloed, and then the infrastructure that allows one to put that data into neural networks in order to commoditize predictions, so in order to ultimately automate processes. And so at the moment, my view is that that dynamic is underappreciated by the market. Of course, Palantir is very generously priced, but although Tesla is on its way to build something fundamental for the economy, Palantir, I think, is going to be more fundamental in that it's building the asset that everyone is going to use to, how do I phrase this? It's using the asset that everyone is going to use in order to profitably use any other platform. Because if you don't have the data, if you don't have the digital twin and the infrastructure that continues to enhance it every day so that you can continue to train neural networks with it, no degree of physical automation on its own is going to enable you to compete in the marketplace.
I think Alex Karp as well recently said that he sees all the value in the market pretty much coming from chips, which we've already seen a massive run up on them companies, and ontology. He made the point that, LLMs are getting a lot of attention. They're getting a lot of hype, but actually being able to have LLMs plus ontology and make real differences to an enterprise, and I guess on the government side as well, is what sets Palantir apart from a lot of other players. And I think I agree as well. And I do think there's a shift happening, like you just described there. I don't know necessarily whether or not I think that Palantir will be bigger than Tesla. I guess it comes down to many questions, the timeline involved and all of these things. But they're my two biggest positions. They're the two companies out of every other company that I'm the most bullish on. I know we're hitting the hour mark soon, so I don't want to steal all your time, but I do want to quickly ask you, we haven't spoken about AMD. Now, I want to know your take on AMD, maybe in comparison to NVIDIA. NVIDIA's had a massive run up, lots and lots of attention there. Why are you not an investor in NVIDIA? Why are you focusing on AMD?
I think that the market is seeing AMD as a distant number two. And there's two considerations that I have to that, which is one, it's not such a distant number two on the AI GPU space. I think that their hardware is going to be able to compete. I think it's already on par in terms of the hardware. And in terms of the software, AMD has taken the open source route. And if you look at the frameworks that people use to code AI systems, basically to call it something, it's PyTorch. And people are working on the open source in order to have software that enables one to run any GPU when you're coding on PyTorch. So the NVIDIA software moat is now going up against the open source. And I think it was George Hotz, the CEO of TinyGrad, I think it was a day or two ago, he said that they basically built a software that perfectly maps software onto both AMD and NVIDIA GPUs on, I don't know exactly what domain of AI, but it's happening. And so I think that it's not such a distant number two. And then the second consideration is that AMD is building a business now which promises to be in around 5 years' time what NVIDIA's AI GPUs business is now, and that's AI at the edge. Because if you look at what's happening now, AI is of course blowing up in the data center, but it's moving out beyond the data center into devices. It's obviously moving into cars as we have autonomous cars. It's going to be moving in everything from healthcare to security devices to anything that's connected in your home, laptops, mobile phones, everything. And so these devices require a much higher level of power efficiency. And the only chip that can do that in a way that makes consumers interested and that is very, very hard to imitate with any other technical architecture is FPGAs. So FPGA stands for Field Programmable Gate Array. And so in 2020, AMD bought Xilinx, which then was the undisputed leader in FPGAs. And what's interesting is that the way AMD has disrupted Intel over the past decade, it's thanks to its chiplet architecture. In that AMD doesn't make a chip out of one single piece of silicon. What it does is connect many small chips, which are known as chiplets. And so this does two things, which is one, it enables AMD to obtain a much higher yield with respect to other competitors, in that if you get something wrong in the process, you don't have to throw an entire chip away. You only have to throw a tiny chiplet. And so that enables AMD to compete in the market on price. And eventually this chiplet architecture, as AMD has compounded it hasn't only dropped prices relative to Intel, but has actually surpassed their performance. And so I believe that's going to happen on the AI GPU side. But then the second consideration is that this architecture enables them to connect different compute engines at will in a way that no one else can, meaning that they can accelerate AI where no one else can. So if, for instance, AMD wants to create an AI PC, all they have to do is attach, I'm obviously making it sound more simple than it is, but this is in relative terms. All they have to do is attach an FPGA to a CPU or to any other compute engine that they happen to sell. And so the AI at the edge opportunity is a $200 billion business in the making right now. And I believe that AMD has a relatively insurmountable barrier of entry at the moment, which the market is not really appreciating. And what's interesting is that AMD can take on both this opportunity and the AI GPU opportunity at a marginal cost, because the source of their competitive advantage is their chiplet architecture, which they've been honing for a decade now. And it's true that NVIDIA with Blackwell has pivoted seemingly to chiplets. But then if you go and look at the architecture, basically Blackwell is two big chips that at the network level act as chiplets, but they're not actually chiplets. They're two big chips, and they're as big as they can be by the limits of physics. And so my view is that for AMD to not disrupt NVIDIA on the hardware side, and of course the software component is very important, but I believe that's coming along too, they have to at some point fully pivot towards chiplets. But the issue is that doing that is not actually interesting for NVIDIA as a business in the short term. It's, to me, a classic example of the innovator's dilemma, because what enables NVIDIA to charge a premium is that they lead in performance by a margin. That's how they make their money ultimately. And shifting to an architecture which doesn't allow you to immediately surpass that advantage in performance, or at least maintain it, is not interesting, because it's going to decrease margins. And so which engineer in NVIDIA is going to be excited to work on a platform which has lower margins and is a far less exciting business at present? That's the essence of the innovator's dilemma. I think that's happening. And I think that AMD can take on these two opportunities at a marginal cost, and more that I think will emerge over the coming years. And so I think the market is underappreciating that. I think this is what gives AMD a better risk-reward ratio. But then I think that fundamentally NVIDIA is an excellent organization. So it's kind of hard to believe that they're just going to sit there and be disrupted. So my investment, my thesis doesn't actually depend fully on AMD disrupting NVIDIA, but rather on AMD's highly differentiated roadmap. which, as I was saying, the market doesn't quite understand. And one of the opportunities on the horizon is AI at the edge, which I think is going to be huge.
Yeah. And I don't think there has to be, in some markets, obviously there will be, but in terms of NVIDIA and AMD, I think these two big companies that are doing wonderful things can absolutely coexist to each other. But thank you, Antonio, for joining me. It's been, like I said, really interesting to hear your insights. I'm going to carry on following you because I love what you have to say and I like all the research that you're doing. You're on YouTube, right? I know you've got a YouTube channel.
Yeah. I'm recently on YouTube, and I post a video every week. Yeah.
Cool. So I'll link your YouTube channel in the description, and I'll put your X account as well. And yeah, I advise you all to go and give Antonio a follow and go and give him some support on YouTube as well, because YouTube's a hard platform. It is it's quite tough to start posting videos. I'm a few years in now, and I still find it very nerve-wracking to press record. So yeah,
it's always hard. You're really good at it, though. I have to say, your channel is growing very
you.
nicely, and the videos are great. So congrats. It's not easy at all.
No, it's not. I still get very anxious about it, but I'm just trying to push myself outside of my comfort zone. And I love learning all about investing in stocks and talking about it. So why not do it and connect with other people that like it as well? So
might as well.
Exactly. So on that note, everyone, thank you for tuning in and listening to our conversation today. I hope you enjoyed it. And thank you again, Antonio, for joining me.
Thank you very much. It was really fun.